2023, the most recommended ETF on YouTube returned approximately 26%. A fund almost nobody was promoting returned 28.80%. In 2024, the YouTube consensus averaged around 14%. That same quiet fund returned 20.09%. In 2025, the crowd averaged 14.97%. The quiet fund came back with 25.49%. 3 years. Consistent outperformance. Almost zero YouTube coverage. Today we are going to show you exactly what that fund is, how it was found, and how to use what we know to build $250,000 on any salary, whether your employer helps you or not. Stay with me, because this one is different from everything else you have seen on this channel and everything else you have seen on YouTube. My name is Sage. I spent over a decade inside the financial system as a Series 7 licensed financial advisor and consumer lender at major financial institutions. I did not read about what works in investing. I worked inside the system long enough to see what actually moves the needle for middle-class families and what keeps them exactly where they are. Here at Financial Methods, our goal is simple: to give you more actionable financial knowledge in one video than most people get from an entire book on the subject. Knowledge that took years to accumulate inside the system, delivered to you in plain language, right here for free. Stay with me to the end of this video, because by the time we are done, you will have a specific monthly number, a specific account structure, and a specific research process that could change your retirement picture permanently. If you are not subscribed yet, do that right now. Every single week, we give the middle class the financial tools the system never handed them. Let's get into it. Meet Marcus, early 40s, has been investing for 6 years, does everything YouTube told him to do, puts money in every month, stays the course, doesn't panic sell. His portfolio has grown, but his colleague at work, same income, similar starting point, different fund choices, has a meaningfully larger balance after the same 6 years. Marcus has been in the crowded pool. Here's what the crowded pool looks like. VOO, the Vanguard S&P 500 ETF, the undisputed king of YouTube finance recommendations, tracks the 500 largest U.S. companies. Excellent long-term track record, owned by tens of millions of investors. VTI, the Vanguard Total Stock Market ETF, covers everything VOO covers, plus thousands of smaller companies. Another YouTube favorite, QQQ, tech-heavy, NASDAQ-focused, heavily promoted by growth-oriented channels. SCHD, the dividend investor's favorite, reliable income plus long-term growth. These are not bad funds. Let me be completely clear. These are not bad funds. They have strong track records and reasonable expense ratios, and millions of intelligent investors own them for good reasons. But here is the problem nobody on YouTube is talking about. When 50 million people are in the same pool, when every YouTube channel, every finance influencer, and every beginner investor starts in exactly the same place, the information advantage is gone. You are not getting ahead of anyone. You are moving exactly with the crowd. The investors who build wealth quietly are not always the ones following the loudest hidden gem. Number 1, 2 questions. Write these down. Question 1, does this fund consistently outperform its own category benchmark? Not just does it go up more than similar funds in the same category? Question 2, what is the expense ratio, and is the performance worth the cost? Most investors never ask either question. They see a fund going up. They hear a YouTube channel recommend it and they buy it. Those two questions are the difference between following the crowd and doing your own research. Everything else in this video flows from those two questions. Marcus ran those two questions against his existing holdings. He discovered his primary fund was matching his category benchmark, not beating it. Good, not great. Then he kept searching. He found a fund that almost nobody on YouTube was discussing. No promotional content, no sponsored videos, no algorithm pushing it into his feed. He found it because he asked the right questions. CGDV, the Capital Group Dividend Value ETF. Here's what this fund does. It invests at least 80% of its assets in dividend-paying common stocks of larger, more established U.S. companies with market capitalizations greater than $4 billion. It is managed by Capital Group, one of the most experienced investment management firms in the world, with a team of veteran portfolio managers. The expense ratio, 0.33%. Approximately $33 annually on a $10,000 investment. Now here is the performance data that stopped Marcus cold. 2023, CGDV returned 28.80%. The large value category average returned 11.63%. 2024, CGDV returned 20.09%. The category average returned 14.28%. 2025, CGDV returned 25.49%. The category average returned 14.97%. 3-year average, CGDV 23.78%. Category average 15.87%. And Morningstar, the most widely respected independent fund research organization, rates CGDV with high people and above average process ratings as of 2026. That is not a promotional rating. That is independent analysis from the firm that evaluates thousands of funds without financial incentive to favor any of them. I want to say this clearly before we go further, and I want you to hear it exactly as I mean it. I am not telling you to buy this fund. What I am showing you is what happens when you stop following the crowd and start asking different questions. This fund was here the entire time, performing consistently, rated highly, and almost completely absent from every YouTube finance channel that claims to be giving you the best investing advice. That is the financial method's difference, not what to buy, how to think. Hidden gem number 2, the free research tool most middle-class investors have never used. Go to Morningstar.com, the free version, no subscription required. Click on the ETF screener, filter by category, expense ratio below 0.5%, and 3-year performance versus category benchmark. Set aside 20 minutes. That 20 minutes is what Marcus did. That 20 minutes is what found CGDV. And that 20 minutes is available to every single person watching this video right now for free. Most investors spend more time researching a restaurant than they spend researching a fund that will hold their money for 20 years. 20 minutes. That is the price of independent research. Start there. Right here. If this video is showing you something new, hit that like button right now. And we want to hear from you. Drop a comment below telling us what financial topic you want us to cover next. We read every single comment. We take every suggestion seriously. This channel exists for you, and the best way to make sure we keep delivering what you need is to tell us exactly what that is. Comment right now. And subscribe if you have not already. $250,000, not $300,000, not some distant retirement fantasy. $250,000 $250,000 in a tax-free Roth IRA with your name on it. Here is what that number looks like on a middle-class salary using a fund that has been outperforming its category benchmark consistently at an 11% average annual return. And we are going to show you two pictures because not everyone watching this has an employer match, and $250,000 should be reachable whether your employer is helping you get there or not. Table 1 with employer match. If you are starting with $10,000, 10 years to $250,000, your personal contribution, approximately $795 per month. 15 years to $250,000. Your personal contribution, approximately $275 per month. 20 years to $250,000. Your personal contribution, approximately $60 per month. If you are starting with $20,000, 10 years to $250,000, your personal contribution, approximately $545 per month. 15 years to $250,000. Your personal contribution, approximately $140 per month. 20 years to $250,000. Your personal contribution, the employer match largely covers it. If you are starting with $35,000, 10 years to $250,000, your personal contribution, approximately $325 per month. 15 years to $250,000. Your personal contribution, approximately $20 per month. 20 years to $250,000. The employer match and your starting balance get you there. Table 2, without employer match. If you are starting with $10,000, 10 years to $250,000, your personal contribution, approximately $950 per month. 15 years to $250,000. Your personal contribution, approximately $430 per month. 20 years to $250,000. Your personal contribution, approximately $215 per month. If you are starting with $20,000, 10 years to $250,000, your personal contribution, approximately $700 per month. 15 years to $250,000. Your personal contribution, approximately $295 per month. 20 years to $250,000. Your personal contribution, approximately $120 per month. If you are starting with $35,000, 10 years to $250,000, your personal contribution, approximately $480 per month. 15 years to $250,000, your personal contribution, approximately $175 per month. 20 years to $250,000, your personal contribution, approximately $60 per month. Two tables. Every middle-class viewer finds their situation in one of them. Now, find your route, find your number. That number, whatever it is for your specific situation, is what $250,000 costs per month. Not per year, per month, starting today. We know that number might feel like a stretch right now. Life is expensive, the bills are real, the paycheck never feels like enough. We are not going to pretend this is easy because it is not. But here is what we know, and we mean this completely. You can do this. The middle class has always found a way when they had the right information and the right tools. Today you have both. And here is something we want every single person watching to hear, especially those for whom even the 20-year number feels out of reach right now. Start with whatever you can comfortably put away this month. $25, $50, $100. It does not matter. The most difficult part of this entire journey is not the monthly number, it is starting. Once that first automatic transfer goes through, once the habit is established, everything changes. We have seen it happen. It will happen for you too. Start where you are. Grow from there. Share this video right now with one person in your life who keeps saying they will start investing someday. Someday is today. Send it to them. And subscribe if you have not already, because next week we keep going. Everything we have covered so far is the what. Now, let's talk about the how. So this is not a one-time discovery, but a repeatable process you own permanently. Hidden gem number 3. The single most important filter in independent ETF research. Any fund that consistently outperforms its category benchmark by 5 or more percentage points over 3 consecutive years belongs on your research list, not your buy list, your research list. The distinction matters enormously. A research list candidate requires deeper investigation, management stability, fund strategy, holdings, risk profile. But consistent category outperformance over 3 years is the filter that tells you a fund is worth that investigation. CGDV passed that filter. That is why it appeared. That is the process. Hidden gem number 4. The math that makes fund selection matter more than most investors realize. Over 20 years, a fund that consistently outperforms its category by just 1% annually produces approximately 15 to 20% more in final portfolio value than the category average. A fund outperforming by 5% annually, like CGDV has been doing, produces dramatically more. Same monthly contribution, same discipline, same time horizon, different research. That is the only variable that changes the outcome. That is why the 2 questions from Chapter 1 matter so much. That is why the Morningstar screener is worth 20 minutes of your time. That is why following the crowd is not the same as following the best path. Everything we have covered is the complete picture. Now here are 5 specific moves executable this week that put it all into action. Hidden gem. Number 5, 5 moves. Move number 1, run the Morningstar screener. Go to morningstar.com today. Free version. ETF screener. Filter by category, expense ratio under 0.5% and 3-year performance versus category benchmark. Spend 20 minutes. Build a list of 3 to 5 funds worth researching further. This is your research list, not your buy list. Start here. Move number 2. Find your row and write down your number. Go back to the 2 tables from Chapter 3. Find the table that matches your situation, with match or without. Find your starting balance. Find your time horizon. Write that monthly number down somewhere you will see it, not on your phone where it disappears, somewhere physical. That number is your target. It becomes real the moment you write it down. Move number 3. Open or confirm your Roth IRA. If you do not have a Roth IRA, open one today. Fidelity, Schwab, and Vanguard all offer them with no minimum balance requirements. The application takes 15 minutes online. If you already have one, confirm it is active and that your funds are invested in something that passed the 2 questions from Chapter 1. A Roth IRA sitting in a money market account is not working for you. Move number 4, set up the automatic monthly transfer. Log into your Roth IRA or 401k account. Find the automatic contribution setting. Set your monthly number, whatever you found in Move 2, to transfer automatically on your payday before the money reaches your checking account. You will never feel it leave. The habit is established once and executed forever without requiring monthly willpower. If your number right now is $25, set $25. If it is $200, set $200. The amount grows over time. The automation is what matters today. Move. Number 5, set your annual portfolio review. Open your calendar right now. Pick a date. January 1st, your birthday, the first day of summer. Set a recurring annual reminder. 1 hour per year. 4 things to review. 1. Does your fund still outperform its category benchmark? 2. Has your contribution percentage increased since your last raise? 3. Is your Roth IRA still the right account structure for your current income? 4. Is your automatic transfer still active and at the right amount? 1 hour, once per year. That is the entire ongoing maintenance cost of this system. Marcus found his ROW. He has $15,000 saved. He has a 15-year horizon. With his employer match, his personal contribution to reach $250,000 is approximately $200 per month. He set up the automatic transfer that afternoon, $200 on the first of every month, into a Roth IRA, in a fund his own research identified, not a fund YouTube told him to buy. He did not need a financial advisor. He did not need a finance degree. He needed 2 questions, 1 screener, 1 table, and the discipline to set up 1 automatic transfer. That is the entire system. We want to say something before we close, and we want you to hear it clearly. This journey is not easy. We know that. The numbers in those tables require real sacrifice, real discipline, real commitment to a future version of yourself over the needs of today. But here at Financial Methods, we believe something completely. The middle class deserves this outcome. You deserve $250,000 in a tax-free account with your name on it. You are capable of building it, and you now have exactly what you need to start. Start with $25 if that is what you have today. Start with $50. Start with whatever is comfortable right now, because the most important step in this entire journey is the first one. The amount grows. The habit is everything. We will be here every step of the way. If this video gave you your number, like it, share it with someone who needs to find theirs, and subscribe, because we are not done. Every single week we bring the middle class the financial tools the system never handed them. The more you know, the more you grow. I'm Sage, and I'll see you in the next one. And as always, we are not done. Next time we bring you something else the financial industry would rather you never fully understood. Stay subscribed. You do not want to miss it.